Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the show where you can have your property related questions answered by our team of property experts. And joining me today is Ryan Hughes, founder of Mr Investa, buy-to-let specialist, and Jamie Pritchard, director of sales for Glenhawk, who are bridging loan specialists. So we'll move straight on to your first question, Ryan. Current government seems to be discouraging the smaller buy-to-let investor with fairly detrimental tax impositions and more regulations, etc. Do the panel think that buy-to-let investments are still a good idea for those who can only afford a small number of properties, i.e. perhaps one or two? What do you think?
I believe so. The returns are still a lot higher than any general savings accounts, and the big factor that a lot of people don't see but should see as part of the strategy is the capital appreciation, because it may not be year upon year, but you certainly do see it over a period of time.
I think one of the things about the smaller buy-to-let investor, I know this, we get lots of questions coming in here about pensions, and of course you can't directly turn your buy-to-let property into a pension, but there's no reason why your buy-to-let property can't be your pension. In other words, the income from it. So it doesn't have to be that sort of formally identified. And I think if the government discouraged too much, I think it'll take quite a lot of opportunity away from people who are trying to, plan for the future, I suppose, really.
A lot of our clients is planning for the future, and we've seen a lot of people using their pension to buy a property for the sort of higher return and that forward planning. That brings a big portion of ours, and sometimes it is one property or two properties. It's not we want a huge portfolio, but they have a set amount of living costs that they know they need to achieve, and they can do that by buying just one single buy-to-let property.
Do you think the government's actions and these sort of forays into the management of rental properties? I know we talked in an earlier programme about government intervention. I know your view is that they shouldn't really, but I don't understand the logic. I mean, surely a good rental market helps the situation of housing stock, does it not?
I personally see a lot of big corporate companies coming into the market, and it's very coincidental that the smaller landlords are being punished and deciding, do we sell, do we not sell, when there's clearly a lack of stock on the market, and there's people with very high targets. They want 10,000, 15,000 buy-to-let properties. It seems like the stars are aligning for a mass exodus as the large corporates are moving in. That's the way I have sort of foreseen it.
But I mean, I don't know. I mean, I can see from a government point of view, it's easier to control, if you like, a big company from the point of view of collecting tax and that sort of thing. But if we start discouraging small private landlords, I think it's really going to starve the market, is it not?
I believe it'll have a detrimental effect. It's not good. The lack of housing, and once you push them out, everyone looks at, oh, but you're getting more owner occupiers on the market. But what they dismiss is all the people that one can't afford to buy the property and have to relocate. And the more that they sell these houses, the private landlords sell them properties, the more housing crisis that we have, because they're not building faster. The more you push the smaller landlords out, especially where houses are concerned, apartments that a lot of them are buy-to-let developments, especially in Manchester, but especially some of the older school houses, it will have a massive effect on the market. It's not good at all.
What do you think, Jamie?
I wouldn't want to dissuade the smaller investors, you say it is, because I think it's still a tangible asset, isn't it? It's a tangible asset that, customers don't understand how the stocks go up, down, and they do a lot of that volatility at the moment, but they really understand bricks and mortar. So I still think it's a viable asset that people should not be dissuaded to get into. The other part of this is that, and actually two parts to this, is what Ryan said there, the government have to actually own a lot of this responsibility, because they've not hit their target of 300,000 new homes a year. They've got 100% success rate of not hitting it. So what are they doing to help that? They're actually trying to help out some of these tenants, as you say, that can actually potentially save up the deposit by trying to relax the affordability rules for lenders, so they're not capped at 3% stress over. But are the lenders going to follow that way to try and make them into owner-occupiers? So, the landlords who are smaller today could be the landlords of the future. The second part is, how many people felt secure in their income that they got from a job that's not being a landlord before COVID? And how do they feel now? The secondary income that 2 or 3 properties could provide today, plus the capital appreciation for their pension later on, so a double bubble, could really help them. So I wouldn't want them to be dissuaded. As I always come back to as a lender, make sure they got the right advice, make sure they know what structure of ownership they're putting it into, and look what their exit plan will be in the future.
So what is the government's idea in discouraging the smaller landlord?
I think Ryan hit it on the head. And I think you hit it on the head as well, is where's that if it's actually a more professional, so professional is portfolio landlord, or it's the companies owning bigger stock, they can go after them and they actually can be able to get the tax from them easier.
You must know, Ryan, in particular, I'm just thinking now about the sort of changing structure of that market. I'm thinking there's one great big department store that's on Oxford Street and has got many other branches around the country, has decided to go into buy-to-let. Well, I can see that because they can put their own furniture in, they can put their own home goods in and all the rest of it. But, a lot of tenants don't fit the criteria that the big companies want. It's like on the high streets, some of the big institutional landlords, we only want blue chip tenants. We don't want the new starts. We don't want the smaller shops. But the life's changed.
The government have changed this slightly. So, it's not that, a few things they've done recently, they're not building enough new homes. So there's a lot of land there that's not being utilised by some of the bigger investors. And I think it was 30 years ago, 40% of all new homes or new dwellings were built by the smaller developers. Now it's actually down to 12% that's done. And the reason for that is that you don't know if you're going to get the planning through and all that. And the high street is changing. So some of these smaller properties and commercial that could be actually converted under permitted developments now into actually residential. So it's actually going to help the high street.
Yeah.
I know the planning officers think they're actually losing control of the high street. So there is opportunity, and the government have opened up some options for them. But back to your question, they're kicking them. And I think it's because they need to get tax receipts in.
Jamie, we'll move on to your question. Could the panel please clarify the purpose and any restrictions or limitations relating to bridging loans? And I presume they mean there, where would it be appropriate to take a bridging loan? And what are the restrictions or limitations?
Yeah, no, it's a good question. And it's one that, it's multifaceted in approach and what you are, but in simple terms, bridging is, sorry for the pun, it's bridging the gap. So it's a bridging for your solution, purchasing or refinancing a property with an end goal in mind. So a few examples of that, which sort of break them down into case studies. It could be that you're wanting to buy the property quick. So that could be auction purchases. Now, when you buy at auction, you have to put your 10% down, and 10% could be at risk if you don't complete on the deal where your finance would be if you're unable to buy it fully cash. Trying to get that through maybe with a high street lender or a buy-to-let lender at the moment, with the length of time that they've got in services at the moment, bridging is the right solution potentially for that deal. But it also could be that you're buying a property that you want to refurbish. So example, £300,000 property that you could purchase at 75% on a bridging finance. But you also know that you're going to put £50,000 worth of work into it. I don't know, kitchen, bathroom, to make it better standard so you can get more yield or actually uplift in value of the property. We'll lend against that 300,000, but we'll also lend against the gross development value of the property. So let's say after you put £50,000 worth of work into it, it's going to be worth 500,000. We can lend you actually the works in arrears to actually fund that. So we'll lend against the end value, and actually then your exit plan is to get out. But so the limitations of that. So on that deal itself, you need to understand your schedule of works, a bit of experience. You need to understand how much is that going to cost you 50,000? How long is it going to take you? The limitations of bridging are, some people would say it's expensive, but I think of it as a business cost. As long as you've actually put those business costs together and understand them, then it's you're still making a profit at the end. It's good. If you go over the term of a bridging loan, that is when it can get expensive. So really understanding the exit. And the other limitation is that I would always make sure that you've got contingent exits, i.e. your plan of your exit, but what would be a secondary exit plan.
Okay. All right, thank you very much for that, Jamie. That's all we've got time for in this half of the show, so join me again after the break. Ryan, your second question. I'm new to property investing and would like to know if my lack of track record in the industry will significantly prohibit my ability to arrange funding for my proposed portfolio of buy-to-let properties. If so, what steps could I take to make the passage to securing funds easier?
I mean, not to go into too much detail from a financial advice point, but one of the big things that lenders tend to look at is if you own your own residential property is the biggest one that I've seen. Are you repaying that mortgage? Credit cards are fine. I'm a big believer in credit cards, building that credit rating. Everything I purchase will be on a credit card and paid off at the end of the month. I don't know whether it works, but it certainly seems to do okay when we go in for lending. That would be my advice. Make sure any debts that you have are minimised, and there's lots of different things in terms of your spending habits.
Look like you're in control, in other words.
Look like you're in control. It's the same as betting, whether it's just the national lottery or bookmakers. A track record of that will go against you. It's the sort of uncertainty and risk that they're looking out for, them names. So make sure you're not, even if it's a direct debit to the national lottery, get rid of it. If you want to do that, go and buy a ticket in the shop. Really? They're the things that I would say in terms of make sure you're not in your overdraft. You know, you're in charge of your finances. You need to basically prove that to someone else, what your lifestyle is, what your spending habits are. If you're on the property ladder already and you're not defaulting on payments, you're in a good position to show that you're able to keep up with them repayments, which should put you in a better position.
Okay, and are the criteria different then for perhaps your own personal mortgage as opposed to a buy-to-let mortgage?
Yeah, I believe so. A main one, obviously everyone has different deposit amounts, but generally buy-to-let will be a 25% deposit, whereas some residential mortgages will start at 5 or 10%. Right. When people tend to have depending on the purchase price, but that 25% deposit, you can see that they're in a better position financially.
Okay, and I presume that's why there's less, I suppose there's less emphasis on age or previous record for a buy-to-let mortgage, because the deposit is higher, and so then the lender risk is less. Is that the key to it?
That's my experience of it, because it's the commitment. You know, how much are you committing to the property? That's what a lot of lenders want to see. It's the same as residential. The more you put in, the better rate you're going to get.
Okay, and how would you demonstrate to a lender your potential ability to be able to run a sort of buy-to-let business? Because that's what it is, isn't it? It's a business.
Yeah, I suppose that's spending habits again. That's what they're looking for, whether it's 3 months worth of bank statements. You need to be as clean as a whistle. Depending on the amount of income that you have, if someone's got an extra £200 and the mortgage is £350, it's not going to work for them.
Okay, all right. Jamie?
Yeah, I've worked for lenders, so I can give you sort of an inside track in this. So everything that Ryan said is damn right. Well, if you're a first-time buyer and you're looking to do that, there's two different things. You could be a first-time landlord or a first-time buyer. If it's a first-time buyer, as a landlord, they will treat it like it's a residential mortgage. So what I mean by that is, generally, they'll only allow you to do 5-6 times of your income as actually the loan amount you'll do. Whereas if it's your next buy-to-lets and your next ones, there is not an income multiple cap, even though we're not allowed to really talk about income multiples anymore, but there's not really an income multiple cap on those things. Also, what comes into it is that there's no minimum income for a lot of lenders out there. But right back to what Ryan said, they will have a look at your bank statements and look at the ability to afford any rental voids.
Yes,
So there's
of
not a
course,
one
yes.
size fits all for the lenders on that, but they'll have a look at your spending habits, like you said, and really have a look if you're able to afford probably 3 months of no rent.
Okay. I was just going to say, what sort of percentage void would they expect? So you think about a 3-month period would be the...
Generally 3 months. And the best information I can give, just to back up what Ryan was saying, is that people send in their applications and think that lenders can't see anything about the customers unless what they've said on the application form. Think of your application and everything that you've allowed them to have a look at, i.e. your credit file, like you're standing in the middle of a greenhouse, and they can see every which way around it. So your habits and what you've done previously will come out.
Okay. And I suppose that's just collected from the usual sort of credit agencies.
Credit reference agency. So you can download, Check My File, Experian, Equifax, have a look what your credit file's like regularly. And as a landlord, experienced landlords listen to this, definitely do that regularly, because if you've put the utilities for your property, and I see a lot of landlords do this, in the tenant's name and they don't pay for it, that's when defaults and mispayments can affect the next mortgage lender you go to.
Got you. Okay. All right. Fair enough. Thank you very much for that. Jamie, your second question is this. Why are bridging loans so much more expensive than conventional bank loans? And in what circumstances would their use be most appropriate? In addition, does the lending criteria is it different from normal lending requirements?
So bridging is seen as a bit more expensive. So, really you can get LTVs up to 75%. In some occasions you can do it up to 90% if it's a below market value transaction. However, what bridging is looked at like is a monthly charge rather than an annual charge. It is short-term finance. So in that nature, it could be rates from as low as 0.4% up to, into the 1% per month. We don't generally annualize them because you could only be keeping that property for 3-4 months before you exit onto a buy-to-let. So it's more risky. It's a more risky investment for the lender, and it's obviously more risky for the customer as well, unless they've had the appropriate advice and they're using it in the right way. So that's why the price of it is more than maybe a standard buy-to-let. But remember, those buy-to-let lenders are actually taking that out over 2 to 5 years. Now, to actually go back, and it's not sort of a historical, I'm not going to do a history lesson, but bridging finance has never been as cheap as it is today. Okay. So we're talking about everyone when it used to be 1% per month and above.
Okay. I mean, is there a circumstance perhaps where you're looking to buy 2 or 3 properties, you're going to go into buy-to-let for the first time, and you think, well, I'll get a short-term bridging loan while I try and arrange long-term finance for my portfolio? Would you perhaps use it in that way?
Yeah, definitely. You could use it for that reason. You can use it as long as it's a business cost, as I've said, I think on a previous program, and you consider it as a business cost. It could be the viable tool. You don't want to get into a sort of chain break scenario where actually someone else is going to win those properties. If it's those 3 properties you really want, bridging could acquire it. So I always think of that as a sliding doors effect. If you're going to pay for the bridging now, or do you want to lose the property? Because you definitely want to acquire it. I wouldn't say buy it now and then just move into a buy-to-let unless it's maybe auction finance, but that could be a viable exit and the reason you do it. Yes. But again, you could be buying those properties, adding the capital appreciation to the property by doing refurbishments on them, and then actually moving it out to a buy-to-let or sell those properties. So bridging can be seen as expensive, but when you see what solutions it solves, I think it's a really viable cost.
Okay. I mean, when you're looking at going into bridging, if you went in those circumstances I've just talked about, would the approval period be any shorter than that of a conventional bank, perhaps? Yeah,
but it can be quick, and there's some of the things and the costs again that you need to think about and where it differs is that check which bridging lender you're using, because some could have exit fees. Approval times need to be generally quicker because it needs to be a quicker process. However, you have got the cost of valuations, which will generally be more. If you're doing a refurbishment bridge, then you may have quantity surveyors or asset managers that need to review the property during the loan.
Would the lender probably insist on a QS to look at?
It depends on the actual size of the refurbishment that you're doing. So if it's something that's light refurbishment, and each lender talks about something being light as something else, but generally that would be maybe an asset manager to assess the property. You've also got the costs of legals as well that need to come into it. so joint representation. To answer your question directly, would the approvals be quicker? Well, we look at things differently. So whereas maybe a long-term finance lender like buy-to-let would look at maybe your income and go through a fine-tooth comb all your bank statements, income, SA302s if you are self-employed. Well, if your exit route for a bridging is sale, we wouldn't need to look at income. Because why? That's not actually forming part of the exit. So there's a lot less maybe required for underwriting, dependent on the lender, dependent on the reason you're taking out that bridging finance. It's a lot more flexible by nature. It's a lot more malleable. So we don't have to tick box the rules. We can make a deal work right if the asset and the customer is something that we feel fits our risk profile.
Okay, great stuff. Well, thank you both very much indeed for that. So big thank you to Ryan Hughes and Jamie Pritchard for their contribution today. That's all we've got time for in today's show. So join me again next time on Property Question Time.